This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Eyebrows raised. AT&T proposes to buy Time Warner for $86 billion. But will the proposal end in wedded bliss? Why Washington may stand in the way.
Deal frenzy from media to aerospace to discount brokerages. Why a flurry of mega deals is happening now.
In the fast lane, the American automaker that did something no other domestic car maker has done in more than 3 decades. Those stories and more tonight on Nightly Business Report for Monday, October 24th.
Good evening, everyone. Neither one of these two are strangers to big deals. AT&T and Time Warner, themselves the products of audacious deal-making, now plan to hook up in an $86 billion merger. It's one of the biggest of all time. The deal would put together the nation's second-largest wireless carrier, a corporate descendant of the great Ma Bell, with one of the most prominent media companies of them all, Time Warner, which traces its roots to Henry Luce and Jack Warner, literally invented the news magazine and introduced the first talking picture. We told you Friday the deal was close, and this weekend it became official. The combination creates a massive media and distribution company. The CEOs, predictably, think it's the next big thing, an irresistible force combining content, innovation, speed, and mobility.
The world of distribution and content is converging, and we need to move fast. And if we want to do something truly unique, begin to curate content differently, begin to format content differently for these mobile environments, and this is all about mobility.
We realized that if we had ourselves together, that we could create more innovations for consumers so they can have more choices of package. They're going to end up with more competition, therefore lower prices.
But both stocks fell in trading today as investors realize that closing the deal won't be easy and, in fact, faces an uphill climb, especially in Washington.
Speaking of which, politicians from both sides of the aisle are raising questions about the proposed deal. This weekend, Donald Trump vowed to block it.
As an example of the power structure I'm fighting, AT&T is buying Time Warner and thus CNN, a deal we will not approve in my administration because it's too much concentration of power in the hands of too few.
He wasn't the only one. When asked on Meet the Press, Democratic vice presidential candidate Tim Kaine said he has some questions.
Generally pro-competition and less concentration, I think, is generally helpful, especially in the media. But this has just been announced, and I haven't had a chance to dig into the details. But those are the kinds of questions that we need to be asking.
And Senator Bernie Sanders said simply, Washington needs to kill it. Eamon Javers is in Washington with more on the challenges this deal faces. Eamon, we heard from Mr. Trump, from Mr. Kaine. What about from Hillary Clinton herself? Has she said anything?
Yeah, Sue, that's the linchpin to this whole thing. Hillary Clinton, perhaps true to form, has been a little bit more cautious about where she stands on this deal. Her campaign did release a sort of a generic statement saying that the deal has to be examined, but she hasn't come out and said one way or the other whether she favors this deal. And given the polls in the presidential race right now, a lot of people are thinking this might land on the desk of an incoming Clinton administration early next year. So it'll be up to the Clinton folks what they want to do with it if she wins this election. So a lot of eyes now focused on her if that Bernie Sanders comment and that Donald Trump comment sort of box her in politically and force her to come out one way or the other on this deal. So far, she hasn't planted her flag yet.
It's interesting, Eamon, usually when antitrust cases come into play, it's two airlines merging to become one really big airline. This isn't that. What's the next step then in the Washington process?
Well, in terms of process, we're going to see a filing in the SEC this week, and we'll expect to learn a little bit more about the deal and where it all goes from here. But we're also going to see filings with the Department of Justice eventually, and then ultimately in November, we're going to see hearings up on Capitol Hill as the Senate Antitrust Subcommittee holds hearings designed to provide a public platform here for both the companies that are trying to do this deal and their critics to air their grievances about the deal and whether they think it'll take out too much competition competition. The companies have been saying, look, this is a vertical merger. It's not a merger of competitors like we've seen in other deals, so therefore it should escape much regulatory scrutiny as a result of that. I'm not so sure that's the case. The populist mood out there in the country that's been driving this entire election cycle that we've been covering doesn't make it a natural fit for a massive $86 billion merger here in Washington.
Indeed. Eamon, thank you very much. Eamon Javers in Washington.
And another big deal, this one in the global aerospace sector, will bring together two of the biggest suppliers to plane makers. Rockwell Collins will acquire BE Aerospace for about $6.5 billion, making this the biggest deal in Rockwell's history. Rockwell Collins CEO said the combination gives it a new path for growth and will let it develop supplies for a so-called smart airplane.
We are currently providing broadband systems onto the airplane to communicate with the ground, onboard secure firewalls for cybersecurity, networks on the aircraft, and in the future, all the cabin systems are going to be nodes on that network. And that's the thesis here, is that we'll be able to bring that networking technology to the products that BE brings to our portfolio.
Shares went in different directions. BE Aerospace took off, up 16%. Rockwell Collins fell more than 2.5%.
And yet another deal. TD Ameritrade will buy rival Scottrade Financial Services for about $4 billion. That acquisition combines the two largest online brokerages and comes at a time when the industry is facing pressure from lower trading volumes and sluggish revenue growth. And TD Ameritrade's CEO says his company has a strategy to gain the trust of younger investors.
We're also investing in even more cutting-edge technologies, whether it be using Amazon Echo, for example, to be able to talk to TD Ameritrade. So we think we'll be well positioned to service the millennial client of the future.
Shares of TD Ameritrade fell about 4% in today's session.
Today's deals don't stop there. Genworth Financial, which provides mortgage and long-term care insurance, has agreed to sell itself to a Chinese investment firm called China Oceanwide Holdings. The deal valued at more than $2.5 billion and comes as Genworth copes with continued low interest rates and rising costs. Shares of Genworth fell on the news. Analysts say the low premium to Friday's closing prices reflects Genworth's gloomy business outlook.
Yet another Chinese conglomerate is going to buy a 25% stake in hotel operator Hilton Worldwide. HNA Group will pay about $6.5 billion for its portion of the company, which it's buying from private equity firm Blackstone. That deal comes as Hilton plans to split into 3 entities later this year and is the latest move into American real estate assets by a Chinese firm. Shares of Hilton rose just a fraction.
And so, from media and telecom to aerospace to discount brokerages and more, companies across many different industries are buying, selling, and merging. In recent weeks alone, nearly $240 billion in deals. And here to discuss why is one of America's most respected deal makers, Robert Profusek. He's chairman of the global M&A practice at the law firm Jones Day. Excuse me, Mr. Profusek. Welcome. Why are these deals happening now?
Well, why not? One of the things when you went through the list, you know, looking for a sort of common thread. Well, certainly there's not an industry common thread. There's been a little bit of a backup in M&A in August and September, a little bit, but there's still plenty of big deals being done. And one of the things is that the market got a little bit lumpy. Everybody has their own theory as to why that is. The election. Discussion of what the Fed's going to do, uncertainty. But, you know, what today proves, or this weekend proves, is still a very strong market, particularly driven by low cost of capital and, frankly, a tepid growth rate that makes you need to buy in order to grow.
Yeah, I hear you saying that perhaps the market has a little bit more clarity on the political side of things. But the higher interest rate scenario, I mean, the Fed is probably only going to raise interest rates once this year and not by very much. How big a factor is that in the move to merge now?
Yeah, there's never one single factor. It's probably a factor. But if you're looking at something very large and there's maybe a 30 basis point swing in rates, you know, now rather than later is probably a good idea. Nothing is driven by a single factor. It's wrong when, you know, you got to search out the headlines, but it's a combination of things. I do think the election and the uncertainty about exactly what was going to result from that that had a negative effect, just like it did on the stock market. And now that it looks more certain, less of an effect.
Yes, I was going to say, implicit in that is what I sense is your view that it isn't as uncertain as it once was. Let's talk a little bit quickly about that idea of not being able to create sort of organic growth, but having to go and acquire it. Is that what's happening here?
Well, when your organic growth rate, your GDP growth rate's in the 150 to 200 basis point rate, that doesn't support a very high stock price. So one of the things that is common among all these deals from this weekend is they're strategic. Sure, people criticize big deals, that it's just empire building. I don't think so. When you think about each of these deals, it had a very strategic purpose behind it. So it isn't about getting better, it's about getting better. Bigger, it's about getting better and synergizing and getting a greater earnings growth than you can in revenue.
What kind of a year do you think it's going to end up to be? Obviously, the Time Warner AT&T deal is huge, certainly, but is it going to be an up year compared to last year, do you think?
Well, it's hard for anything. Yeah, last year was over $4 trillion. That's probably not going to be seen again for some time, but it's going to be just as good as 2014, that we all thought was a very good year. So, you know, the year-over-year comparisons are a little bit negative, but that's because they're being compared to an astonishing year. I still think as long as money's cheap, there's going to be plenty of deals.
Very quickly, if you might, sir, do you see on the face of it any antitrust issues with AT&T Time Warner?
Well, it is a different deal. It's not horizontal, as was said earlier. It's vertical, but obviously we're in a different political environment, so it'll be looked at. The analogous deal, Comcast, took a year to get done.
Robert, thank you very much. Robert Profusek with Jones Day.
And as the pace of merger and acquisition activity picks up, who might be next, especially in the fast consolidating media and communications industries? Julia Borston takes a look.
The end of traditional TV is getting closer, and media companies are scrambling to position themselves for the world where customers get exactly what they want on their mobile devices. We could see other distributors, such as Verizon and Charter, follow AT&T's lead.
To the extent that our strategy succeeds, I think other companies will try to look like us. If our strategy doesn't succeed, other companies won't bother, right? And so I think it's a function of how well we do together in pulling this strategy off.
Tech companies Apple, Google, or Amazon could be buyers as they all put together more video offerings. And for content creators, this deal creates more pressure to consolidate for negotiating power with distributors.
If you go across the large cap media space, CBS and Viacom with common, voting control already in discussions about a merger. I think this probably slightly increases the odds of that happening.
Fox, which made a failed bid to buy Time Warner a few years ago, could be looking at other deals. And smaller media assets such as AMC Networks, Discovery Communications, Scripps Networks Interactive, and MSG Networks, whose channels are at risk of being excluded from skinny bundles, could be snapped up. But analysts warn that prices would need to come down first.
I'm not sure that there's many Silicon Valley companies who want to pay a multiple on the affiliate fee model that basically they think they're destroying. They might want some content, but that's different than buying television networks. So if the buyers emerge, I'm sure we'll have some willing sellers.
And when it comes to streaming giant Netflix, its $55 billion valuation means not many could buy it. But if the likes of Apple were to step up, it would be another game changer for the fast-moving media space. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Well, all of the deal news spurred some optimism on Wall Street today and helped prop up the broader market, but the gains were capped by a rising dollar and falling oil prices. The Dow Jones Industrial Average rose 77 to 18,223, had been up 130 points at one point. NASDAQ gained 52, S&P 500 up 10.
A Federal Reserve official today said very low interest rates will likely be the norm for the next 2 to 3 years. St. Louis President James Bullard, a voting member of the central bank's policy setting committee, reiterated his view that only one more interest rate hike is necessary before holding steady. Bullard said he thinks the path of rate rises should be so slow as to be imperceptible.
The Dow component Visa reported a sharp rise in profits as customers spent more using its network. The world's largest payments operator was also helped by its acquisition of Visa Europe. U.S. accounted for about 41% of total payments, Europe about 25%. Visa earned 78 cents a share. That's 5 cents above estimates. Revenues climbed 19% from a year ago to $4.2 billion. That was also above expectations. The stock volatile in after-hours trading, and as Aditi Roy explains, that may have something to do with the company's outlook.
While Visa beat expectations on the top and bottom lines, its forward-looking guidance for the coming fiscal year came in weak. The company projecting net revenue growth for fiscal year 2017 at 16 to 18%. That's lower than street expectations of 20%. Its projected EPS growth for the coming fiscal year is in the mid-teens. That number also missing expectations, with the street looking for 19% growth. The report coming on the heels of the company's announcement last week that CEO Charles Scharf will be stepping down and board member and former Amex president Al Kelly will be taking over. The latest earnings also reflecting the company's acquisition of Visa Europe earlier this summer. For Nightly Business Report, I'm Aditi Roy, San Francisco.
Still ahead, blurring the lines. Big tech is circling telecom, but telecom is fighting back, and these powerful industries may never be the same.
With its proposed bid for Time Warner, it is clear that the boundaries between technology, telecom, and media are not as defined as they once were. Deirdre Bosa explains.
With AT&T's bid for Time Warner, a new wave of media change may have just begun. And the line between media, telecom, and tech is becoming blurred.
And I think the reality is, as we shift to an on-demand world without commercials, as we move to a mobile-first environment, the media industry, the legacy media industry, meaning the cable network product that kind of has been the basis for all of the media stocks, is very challenging.
And this big shift is a big advantage for tech companies. Just last week, YouTube CEO telling the audience at the Vanity Fair Summit that YouTube sees itself as a platform for next generation TV.
I think the question is whether you define TV as the content or the platform, right? Back to your original question. And I think the content is going, over time, is going to morph more to an online type of platform similar to YouTube, where content is available, on demand, it's global, and it's interactive. And so when we think about YouTube, we think about being a platform for the next generation of media companies, and traditional media companies too.
And that makes traditional media companies nervous. It's not just YouTube and Google, but also Amazon with its own original content and distribution channels, Apple TV, and Facebook's push into video. Big tech is starting to look a lot like media. It's also encroaching on telecom's bread and butter distribution business. From financing their own undersea cables to satisfy bandwidth needs, we're offering ultra-high-speed internet as Google Fiber already does in 9 cities. With tech, telecom, and media now playing in the same sandbox, they may start competing for the same assets. The AT&T Time Warner deal reportedly came together quickly as Apple and others were circling. In a consolidating media landscape, the tech giants will continue to play a major role. For Nightly Business Report, I'm Deirdre Bosa, San Francisco.
Kimberly-Clark cuts its outlook after a disappointing quarter, and that's where we begin tonight's Market Focus. The consumer products company missed analysts' estimates for profit and revenue, citing currency headwinds and a competitive environment. The maker of Kleenex tissues and Huggies diapers then lowered its earnings forecast for the year. Shares finished the day down nearly 5% to $113.91. T-Mobile posted higher than expected profit thanks in part to an increase in customers. The wireless carrier is optimistic that momentum will continue, saying it expects to add more customers this year than it previously forecast. The shares popped almost 10% to $51.19. Restaurant brands topped profit expectations as the owner of Burger King benefited from higher sales in some foreign markets. But the company's same-store sales grew at a slower clip than last year due to sluggish demand in the U.S. and Canada. Shares were off nearly 5% to $44.67.
VF Corp posted worse than expected revenue as weak demand in the apparel retailer's denim division hurt results. The owner of the North Face and Wrangler brands did report a higher profit, but still the company cut its guidance for the year. But VF did raise its quarterly dividend on this day, nearly 14% to 42 cents a share. Nonetheless, shares down more than 2% at $53.07. Microsoft said the steep drop in the pound sterling following Britain's vote to leave the European Union has prompted the company to raise prices for its software and cloud services in that country. Starting January 1st, business customers can expect to see a price hike of 13% for enterprise software and an increase of 22% for enterprise cloud services. Shares were up 2% on the day at $61 even. Shares of the restaurant chain Sonic took a hit after hours following a downbeat earnings outlook for the year. The company also said profit and revenue were hurt in its latest quarter because of, quote, slowing consumer trends. Shares initially fell 10% following the after-the-bell news, but finished the regular session up more than 1% to $26.49.
A lot of money has been pouring into passive investments like mutual funds and ETFs. It's a trend that we have been reporting on. But ETFs, or exchange-traded funds, are multiplying like crazy. And as Mike Santoli reports, not all of them are created equal.
Exchange-traded funds are a bit like the smartphone apps of the investing world. They're remarkably cheap and useful. New ones pop up each day to fit every narrow interest, and there are far too many of them. Because they offer efficient exposure to stock and bond markets at low cost, ETFs are one of the hottest growth areas in financial services. There are some 1,700 ETFs controlling about $2.4 trillion in assets. Still, the market is dominated by a handful of very broad funds. The 10 largest ETFs, including State Street's S&P 500 Trust and the Vanguard Total Market ETF, command more than a quarter of all ETF assets. This has driven fund companies to push a variety of gimmicky or highly complex ETFs to appeal to niche interests. Among such offerings, an ETF to play the whiskey industry, one for the drone economy, and others for most every agricultural commodity. The success rate of new ETFs is pretty low. More than half of all listed funds have less than $100 million in assets, a common threshold for determining a fund's viability. And one website that tracks what it calls an ETF death watch now lists more than 400 funds vulnerable to closure based on size and trading activity. One promising area within ETFs is known as smart beta, where funds that pursue an automated stock selection strategy or feature some investing factor meant to outperform the broad market. This could be cheap stocks or momentum stocks or those with some other trait. These are crowding out traditional higher-cost mutual funds run by human portfolio managers. All this innovation and downward pressure on costs ultimately can work to the benefit of small investors who can use ETFs to construct a low-fee, tax-efficient portfolio. But as with the surplus of phone apps, it's important to avoid the frivolous or costly ones. For Nightly Business Report, I'm Mike Santoli at the New York Stock Exchange.
Coming up, auto reliability, the American automaker that just broke a 35-year losing streak for domestic brands. See if you can guess which one. Here's a look at what to watch tomorrow. 7 Dow components report earnings, including Apple, 3M, Caterpillar, and Merck, among others. The future of digital payments and financial services will be the focus of the Money 2020 event. And we'll get a read on home prices with the release of the S&P Case-Shiller Home Price Index, and that's what to watch Tuesday.
The White House today confirmed that health care premiums will go up sharply next year for insurance sold through healthcare.gov. Before subsidies, premiums for a mid-level plan will increase on average 25%. The administration says that the subsidies will help offset that price increase, but it comes as a number of insurers have pulled back from offering plans in the federal market. Open enrollment starts November 1st.
Well, today brought a surprise in the rankings of car brand reliability. The latest report on that shows a Japanese brand stumbling, while a domestic brand has jumped to near the top of the list. In fact, for the first time ever, Consumer Reports puts a domestic brand among the 3 most reliable auto brands in the U.S. Phil LeBeau reports.
They're not the flashiest models for sale, but Buicks are turning heads, especially after the latest report on auto reliability by Consumer Reports, which ranks Buick as the 3rd most reliable brand behind Lexus and Toyota.
If you look at the top 3, it's Toyota and Lexus. No surprise there. Conservative companies that have a real good reputation of putting out reliable vehicles, but above any of the other Japanese automakers, above Honda, above Subaru, we see Buick. That is a big deal.
While Buicks are getting better according to Consumer Reports, Hondas are not as reliable. In fact, the latest version of the Civic, one of the most popular cars in America, dropped in the survey due to problems with the powertrain and infotainment system. Honda says it respects the survey results and is working to enhance the usability and functionality of its vehicles. Meanwhile, issues with the Falcon Wing doors in the new Tesla Model X are one reason Consumer Reports ranks it as the least reliable luxury midsize SUV. But the brands with the poorest rankings are Ram, Fiat, and Chrysler.
Fiat Chrysler really continues to stumble. The platforms that they have from Fiat have not proven reliable.
Fiat Chrysler says despite the survey results, the company's own internal measurements continue to show positive growth toward vehicle quality. This survey is based on Consumer Reports subscribers critiquing the cars, trucks, and SUVs they own. Their most common complaint? The infotainment systems in these cars are not always working as they should be. Phil LeBeau, Nightly Business Report, Chicago.
And that will do it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching.
And thanks from me as well. I'm Tyler Mathisen. Have a great evening, everybody, and we'll see you here tomorrow night.